Hey guys, welcome to Consider This. I cannot believe that we have finally reached the point in time where this is a weekly live broadcast. People have done this for some time with I don't know, problems, challenges, whatever. This is our 22nd year to do the radio show. Angie's been on the show for 5 years? No.
No, 2, but it feels like 5.
It feels like my whole lifetime.
Feels like
No, seriously. Welcome to Consider This. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. So here's the deal. We spend our life at the Financial Enhancement Group trying to help people reduce financial regrets. That's our thing. We're registered investment advisors. There are 29 of us that are on the team. Everybody is paid a salary, has health insurance that wants it, has a 401k that is contributed to. We truly are a company. We believe that no one person, including me, can do this on their own. And so we put this show out waiting for you to raise your hand and go, hey, I'm having something happen in my life right now where I need some financial help. And whether that is one of the CPAs, one of the enrolled agents, a CFA, a chartered financial analyst, a chartered market technician, a CFP, that's what my credentials are. Whether that is one of us or the whole collective of us, we want to help you fix your problems or reduce your financial regrets before mistakes are made, because it's so easy to happen. So Angie and I do the show every week. We've always done it where we are on radio. This is our first official week for you guys to be able to see us live. So welcome. Happy to have you along. Angie, I know you have something you want to say for the intro.
Okay, so
I know your time's almost up.
Yeah, it is.
It is my show.
But, okay,
I used to tell people, you know what they call it? Consider this with Big Joe Clark. Now we don't do that anymore. Angie actually gets separate billing.
So back in February, when the U.S. State Department issued like a global 4 pandemic, it meant 3 words: do not travel. So
That's what global 4 means?
well, in our world, Kiplinger did an article that said 93% of flights dropped the next day after that announcement from the prior year that day. 67% of people have said that it affected their travel plans. So basically, they had a great article about 5 ways to see the world without leaving your home. So you should look it up. It's got, they have one thing that has you can go into a live volcano and do a virtual 360 tour.
Oh, wow, that'd be cool.
So,
all right, we're going to take a break. We'll come back to that. And I have no issues talking with that. So we'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This. And some of you may be saying, what in the deal is good morning? You're streaming the show at 5 p.m. Eastern Standard Time. It's morning somewhere. It's just not morning here. And the answer is, we've always done this on the radio. And our largest show airs at 6 a.m. on Saturday mornings on WIBC in Indianapolis. And yet here we are. Hopefully, this will be our largest platform at some point in time. But in the meantime, welcome to Consider This program. I'm your host, Joe Clark.
I'm Angie Kinzer.
We have lots and lots to talk about, but there's nothing probably more important than your questions. That's why we built this show, is to help you reduce financial regrets, to let you understand what it is we do. So our brand promise is our next steps meeting, which Angie's going to explain first and foremost.
Yeah, so if you call in and request a next step meeting, We will set up a time for you to come in, meet with one of the advisors, and we'll give you things to consider today, things to consider in your future. And then if we do decide to partner together, things that FEG will do for you.
There you go. So 800-928-4001. You get to talk to Angie if you call. Just ask for her. And of course, you can go to our website at yourlifeafterwork.com. So we are going to talk about one of the things that I am very passionate about. It is charitable gifting. And Angie, as you know, well, maybe you don't know, but now you do. Angie gets to enroll the questions. You call in, you email in, you ask. She creates the questions. I do my best to answer. And so this segment, if you will, this part of the show is about charitable gifting strategies.
Yes. Yes.
And I will tell you the context for this. I think it was 2016. Time flies, Angie. I think it was 2016. I looked at my tax return. We itemize, and we had to list all of the individual charities that we sent money to. And I believe that's part of a business owner's responsibility. I believe it's part of an American's responsibility. We are supposed to support causes that we think are good.
Mm-hmm.
I looked at that list, and there was a lot. Wasn't necessarily huge amounts in each one of them, but it was a lot of different entities. And for me to say that I could tell you where all the dollars went and what they did with them would be a fib. And so we created what we call the Better Giver program. You can find that on our website. My job is not to help you or to encourage you to give more. I think that's something between you and your spouse and how you feel about the world. So I'm not trying to help people or encourage people to necessarily give more. What we're trying to do is to help people give more efficiently. That's my side from a tax standpoint. Now, Aaron Rayum, who's our director of financial planning, has a huge objective. He wants to have people give millions more than they had planned on giving over the course of his career. And that's part of what drives him. He's part of what's called Kingdom Advisors, where there's a Christian affiliation that is behind that. But we all have different viewpoints and different perspectives. What we want to do is make your life better. And that's why we do the show. And when you're ready for a Next Steps meeting where we can help make your life better, you just let us know. So, Angie, go ahead and fire away with your questions.
Okay. So what is a donor advised fund?
All right. So there are going to be periods in your life where you have the capacity financially, not emotionally necessarily. What I find is people tend to want to give more the older they get, maybe because they think the clock's running out, right? They want to be able to say, hey, God, I did my thing, right? No. Usually people make more in my age and your age. We won't tell you how old Angie is. I'm 53 and we graduated the same year. Other than that, we're in our highlight of earnings years based on where all the demographics work.
Yeah.
Right. As people get into their 60s, their incomes tend to go down unless they're in a higher end of the structure. But what I see is that their giving, their desire to give goes up. And that occurs because they've got more wealth than they need.
Okay.
It occurs because their kids are finally financially neutral. Right. You know that. You've got a child going off to, Ava, incredible young lady, is going off to college for the first year. She's heading off to Ball State. She will not be, just so you know, I don't want you to have any surprises.
Okay.
She will not be financially neutral for a while.
No.
Right? Financially neutral, just in case you've never heard that terminology, means that Ava's not asking Angie for money, but she's not taking it either. Angie,
What do you mean she's not asking me for money?
No. She's not providing you money,
Okay.
right? But she
Yes.
is asking you for money. She is not going to be financially neutral.
No.
Right? There's going to be car payments, insurance payments, gasoline,
Yes.
cell
all
phone
of those.
bills, all of those things. When you get into your 60s, what tends to happen, then 70s, is what tends to happen is people have more financially neutral relationships where they can make different size of gifts. Okay? So you need to understand this. And one of the biggest keys to financial success is understanding that you are on a financial journey that doesn't just have 2020 in the playbook. It's something that's going to go on for years and years and years. And so we try to help as part of our process, our trademark program, the Family Focus process. We try to run people through a financial vision so that you can articulate precisely what it is you care about, so that it may be something that you're wanting to respond to, develop, whatever you want to say, 10 to 15 years from now, but you're actually financially funding it today. And a donor advised fund is one of those things. It allows you to contribute money today into a program that allows you to gift later on.
Now, could it reduce a tax burden, like say in a windfall year?
Yeah, so that's one of the reasons why you would do a donor advised fund. Some people look at charitable remainder trust as one of those things. That's probably another question that you have.
Yep.
And a whole lot longer conversation. But in a donor advised fund, I can make a gift today. Whereas I said, Angie, we're maybe in our higher income years. So if you're able to itemize,
Yeah.
you may want to make a gift to a donor advised fund today, even though you may want to use it for gifting 10, 15, 20 years from today.
Gotcha. You mentioned a charitable remainder trust. How are those taxed?
It's one of my favorite tools. You actually make a gift to a trust that is going to provide you income today. And when you're gone, the charity gets the remainder, hence charitable remainder
Okay.
trust.
Yes.
The key thing here is you get a deduction for the gift that you make. But Angie, the gift is greater, not based on your health, but on your life expectancy of average 53-year-olds. So some would tell you that I'm a health freak, so I'm in better shape than the average 53-year-old that's walking the planet. That may be fair. It may not be fair. Who knows? When God's ready, I'm ready, right? I mean, it's going to happen. But he's going to look at all 53-year-olds. Or the IRS is going to look at all 53-year-olds. And if I made a gift of $1, the IRS is going to discount it based on my age, right? Not my health. So the younger I am, the less benefit from a tax perspective that I get to make the gift.
Okay.
The older I am, so if I'm 97 and still hiking mountains, right, then we're going to do a lot of charitable remainder trust, because the IRS is going to give me virtually $1, for every $1 that I contribute, even though I'm still here, and it's going to pay me an income along the way.
So what about outright gifts? How are those taxed differently?
So if you're, and this is new to 2020, and remember, you hear a lot of things that are discussed that came out of the CARES Act, which was March 27th because of COVID. This is actually part of the Secure Act, right?
Mm-hmm.
So in the change that occurred in 2017, effective January 1 of 18, your standard deduction was increased to a level where very few people, family-wise, in America are able to itemize. You get big three things that you can itemize: your home mortgage, your state and property taxes, and your charitable gifting, right? So your SALT taxes, as they say, which are state and local taxes, are limited to $10,000. So for some people in some states, New Jersey, New York, California, almost all the reasons anybody itemized was because of quote-unquote SALT tax. Well, now that that's capped at $10,000, married filing jointly, if you're under 65, your standard deduction is now $24,000, right? If you're over 65, add another $1,300 apiece, so it's $26,600 to that number, right? So you've got the SALT taxes, which are capped at $10,000. Mortgage interest, in all fairness, most people at that age have already paid their home off, right? And then you get to the third part of that environment, where you have the charitable contributions, and a lot of people just don't go to that limit. So what happens is the IRS, effective 2020, you can now make a $300 charitable deduction, and it's what we call above line. So Angie, stay with me. This is very technical. The line is called adjusted gross income.
Yep.
If you do something above the line, above your AGI, it's called an above the line deduction. What do you suppose happens below the line?
Maybe it's called below the line.
A below the line deduction. Very, very good.
Yes.
Right? You always want, anytime you can, to have above the line, not below the line. And so now everybody can do a $300 charitable contribution, not have to worry about taking the itemized deduction, and they're still able to support a church, a charity, a teacher, whomever, right? And that's really where it comes from. But when you make charitable contributions to not-for-profit entities, what we call 501c3s, in most families' cases, they're no longer able to deduct those. So we have strategies that we would talk about if you happen to come in and visit,
Yep.
have a next steps meeting. We give you things to consider today, things to consider in your future, and if we choose to partner together, things you're going to want to consider, or what FEG will do for you. One of those things that we would definitely look at is structuring or laddering your charitable gifts so that not only the entity gets the most benefit, but your tax return gets the most benefit. So give Angie a call at 800-928-4001 or go to yourlifeafterwork.com and just tell us it's time for a next steps meeting. We'd be more than happy to sit down with you. There's 29 great people on the team.
Hey, we have an easy button right on our
I
website.
like it. Easy.
Schedule an
Easy
appointment.
is good. Yourlifeafterwork.com.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This program. I am your host, Joe Clark.
And I'm Angie Kinzer.
I think the title of this segment, and Angie's got a better go ahead. What's the title?
It's Avoiding a Tax Audit, and what do you do about it if you're called?
So I'm going to walk you through the history of some of the tax code so that you can understand what that is. I think a lot of people, especially older than you and I, Angie, live in fear of an audit. I don't know if any of our millennial team actually even know what an audit is, but I did learn something today.
What's that?
And our business manager, Vicki Milady, we have a message machine. We have families that we take care of in 31 states. And so we have a message machine that can find us anywhere. And it does. And so she's had 3 messages from the Internal Revenue Service on voicemail. And I actually called one of our CPA partners today. And typically the IRS will not call. If you get called by somebody who says they are from the IRS,
Usually a scam.
I would have told you it's always a scam. This was not a scam. The lady said, hey, we're talking about 941s, or which are essentially withholding stuff for the part of the team. And we're working from home, so we're having to call on our home phone numbers because of COVID. Who'da thunk, right? So I cannot tell you any longer without any question or hesitation that if the IRS calls it, if somebody says they're the IRS, they're always scamming. I would always tell you to be careful. But Vicki assures me that this call was actually real. So let's talk, before Angie gets into her questions, let's talk about how audits and the IRS used to work. So what the IRS is trying to find, or used to try to find, are people who are willingly or accidentally not properly reporting data, right? And they would go through a series of things that we used to call the DIP. And essentially it was a 50,000 very lucky Americans who were going to be audited line by line. And they were going to go through the DIF and try to figure out where there was a difference between my tax return and your tax return, or find farmers or attorneys or pharmacists or engineers that had similar technical challenges. This was not a fun audit, and in my opinion, should have always been against the law. But it wasn't, and it happened every single year. That really got changed back in the Reagan era. So we're talking about mid-1980s, where that was eliminated. Now, the extreme majority of your audits that occur are based on a computer program. You have these things called a 1099.
Yep.
And that 1099 is where you have income that is reported. I call it a money in motion form. Not all 1099s are reportable on your tax return. They're all, however, reported to the IRS. Right? And so you have this document, the IRS has it, their computers read it, and Angie, they look at your tax return, and you have no said 1099 attached, right? Then they're going to send you a Dear Angie letter. You owe money, right? So I had a big check that was returned to me one year from the IRS because I overpaid. Just for the record, sent in regular mail with a U.S. postage stamp. Later that year, I had a 1099 that was missing. I kid you not, for $11.97. It was sent first class, hand delivered, right? The UPS, I can't remember if it was UPS or FedEx. I ought to remember this, but it was certified mail. I had to sign for it. It was $11.97. It probably cost our government to send to me what I owed. And the check that they sent me that was my money came back in regular mail. I have no idea why the IRS and I have such issues. Anyhow, I'll move on to your questions.
Well, if you do get audited, I mean, what kind of things are you going to have to provide?
It depends what they're auditing. So under that diff that we talked about, they wanted everything, right? They wanted to, they literally, it was a line by line audit, right? Most of the times, the audits that you have today, they're looking for something particular. And the things, especially as you get older, that get left off tend to be little bank accounts, little brokerage accounts, those kind of things, stocks that you have that haven't been transferred into account. One of the things that we help people do is to simplify life. One of the best way to reduce financial regrets is to create a simplification. And so we use the largest custodians in the country to be able to take your assets, put them in one place, and report on them at one time, so that you have a better handle of what's going on. And when you can't do it, your kids have a clue, or whoever runs your estate at that point in time have a clue of what's actually going on.
I do want to address some questions that came in from the first segment, but to end this one, I did get our top 7 things that you can get audited for. They were making math errors, failing to report income, claiming too many charitable donations, that's on there, reporting too many losses on Schedule C, claiming an in-home office deduction, and using nice, neat, round numbers.
Yeah, we one of the people in one of the old accounting firms that I've spent 20 years working with, and I'm not supposed to tell you the numbers, but there are numbers that when people when they would bring in tax returns that didn't quite pass the smell test, they would give them to her. And there are numbers that you commonly use that show up in the daily world. One of my favorite podcasts, so Angie and I fight over this. One of my favorite podcasts in the world comes from Donald Miller. And great Christian man, Nashville, Tennessee. Really, really love his work. And today I was listening to a guy that talks about why you use pricing of $49.99 and not $50. Which Angie, by the way, thinks is cheap, and you're trying to create a problem.
It's gimmicky.
Let me finish.
Okay.
The $49.99 is not gimmicky. You like 9s better than 0s. You don't know why you like 9s better than 0s. I have no idea why you like 9s better than 0s.
Okay.
But research done at Harvard and Stanford and a few other places will tell you there's numbers that you like more. And it goes to the same conversation that when people are cheating on their taxes, I'll give you one of those. Use a 7.
Really?
Numbers end in 7 are many
Made up?
times. There's not a lot of things. Think about dice and everything else. There's
Okay.
not a lot of numbers that add up to that. You're limited to 6 and 1, 3 and 4, 5 and 2. Those are not things that people will usually use as a price point. And so those are things they look at. All right, go ahead and ask a question.
Okay. Someone has asked, how has the Secure Act changed how my IRAs work with my trust?
Oh, good Lord. Almost all of it. and I've only got 4 minutes and I need 5 hours. So the biggest part is when you have a trust, you're trying to do, if you have a revocable living trust, what you're trying to do is to control your probate costs. You're trying to control federal estate taxation. But the key word in both of those is control, right? So you have a trust to control how other beneficiaries behave. So something happens to me. Let's forget that there's Barb and Kaylee and Kendra. Let's just say I'm leaving everything to Angie. I'm not. I want to make sure that she's aware of that. But let's say I was leaving everything that I owned to Angie inside of a trust. I can control how that money is distributed to her. The problem is, from my IRA or my 401k, she has to pull all of that out of an account to recognize it as fully taxable over a 10-year period of time. I won't tell you that the great legal minds of the world will not figure out how to solve that problem over the next few years. I will just tell you that today, the last thing you want to do is have your IRA inside of a trust to be distributed because of most of that language. The things where you would want to keep control, this is not one of them that you can do it that way.
Gotcha. If I'm selling my business, how do I get it evaluated?
There are people who do that. And you'll hear all sorts of stuff. EBITDA is one of those terminologies that's done where we have CPAs. It tends to be them who are certified valuation specialists, and they come in and look at your business. But it's no different than a stock. Some days stock trades higher than at others, right? And we call them multiples. And so they're going to look at what your assets are worth, your inventory, your receivables. They're going to look at your buildings. They're going to look at all of those things, and they're going to give you a valuation. And then they're going to say, what would a third party, right? So not somebody that's your neighbor, your best friend, your child. What would Joe be willing to pay to buy said assets? And that's where they come up with a valuation. And that matters from an estate planning standpoint. And Angie's going to get mad because I'm going to now derail the show. But the bottom line is we've got another 5 years. Yes, I know. I do it all the time. We've got another 5 years before the tax code sunsets. And when that happens, you want to make sure that your estate plan is already ready to roll. Call Angie 800-928-4001. Get set up for a next steps meeting. We will tell you things you need to consider today, things you're going to want to consider over those next 5 years because things are changing. And last but not least, if we choose to partner together, what FEG will do for you. Okay, you have a minute left.
Oh, well, hey.
I'm trying to be helpful here.
Okay. Well, let's see.
I don't know. We're having more fun with this now being streamed. I have no idea why that is.
I think we're being actually nicer than we normally are. Usually you get some faces and some hands.
Well, you deserve faces and hands.
I know. But
anyhow, if you're thinking about a trust, or if you already have a trust, remember it's not a checkoff list. Right? You can't do this once, have the trust checked off, and assume that you're done. We have people who bring in trusts that are 20 years old, 15 years old. Folks, it doesn't work that way. My trust is dated in 2002, and it has been updated 5 times since then. Almost always because of tax code change, not because of a Joe attitudinal change. And that's the part you really need to be aware of. Give Angie a call, 800-928-4001. And keep in mind, we are not attorneys. We do not play one on radio nor TV. But stay tuned. We'll be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program as about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. I miss happy.
Happy.
We need the duck people back. That's all I'm saying. Anyhow, we'll go from there. What's the topic that you would like to discuss?
We're going to talk about IRAs and your beneficiaries and some of the strategies with the new rules, because one of the questions I did get last week is, what are some of the new rules that impact me as a beneficiary?
So remember, if you call into the office, Angie's the one that you're going to talk to. She's the one that controls the calendars. That's an important thing. If you email us and you have a question, she's the one who puts it on the show. So what I'm here to tell you is that Angie is more important than I am. If you want a question answered, right?
Yes.
I
can get you the question.
We have other people on the team who could answer the questions. I've just done this for so long that people think I need to be the radio. Do not forget that you've got Grant running the helm right now tonight. So if you've got a question on Facebook or Vimeo or our Facebook, you may get the question answered on the show. You may get it answered that way. He is one of our top financial planning associates, an absolutely incredible advisor, one of my students from Purdue years ago, and I'm just very proud of him. So there you go. All right. Ask the questions.
Okay, so how are the rules different for, say, children than a spouse when it comes to...
So you have two types, actually you have three types of beneficiaries with an IRA or a 401k. You ready? These are really technical. It's kind of like above the line, below line.
Yeah.
Right? You have a non-designated, right? That means I left it to nobody, which invariably falls to your state. You have a non-spouse. What would you suppose that is?
Non-spousal?
Hey, don't look at me. The IRS comes up with these rules, right? I have spent hours and hours and hours of my life reading non-spousal versus spousal, right? So they apparently think this is important. You cannot shrug off. See, that's what they would have never seen on the radio. Now they know that you are passive-aggressive, Angie Kinzer. Anyhow.
That is not true.
Back to this. Oh, it is true. Back to this. You have a non-spousal. So is Ava and Kaylee, I should say are probably, are Ava, Kaylee, and Kendra spouses or non-spouses?
Non-spouses.
They're non-spouses. And Barb?
She's a spouse.
She's a spouse. That's my wife of 31, almost 32 years, right? I can leave money no differently than how it was prior to the Secure Act back at the end of 2019. I can leave money to Barb the same way that I could have left it before. She has the ability. Now, that side note, if you're listening to this, it doesn't mean that I should. And this is where this is where the controversies are going to pick up. I could have left it all to Barb, right? So now Barb would have her Roth IRA money, my Roth IRA money, and my 401k money from the Financial Enhancement Group, right? It would have all been in her name. We're virtually the same age. I'm 6 months older. So she would have still had to take it out based on required minimum distribution ages established by the Internal Revenue Service, based on where our life expectancy is. Now, those numbers are actually changing. So that's one thing. It's not going to affect you one iota, as my Aunt Heidi would have said. It's immaterial, but it's going to be a very, very small number. If you have a $10 million IRA, this is a big deal. If you don't, it's probably not that big of a deal unless you're 94, and then it could be a big deal. But we're living longer. And so part of the life expectancy table is getting adjusted, as it should. I leave everything to Barb. Barb has to begin with required minimum distributions. At what age, Angie Kinzer?
72.
Woo! She is on it. She is on it. See, here's the deal. It was 70 and a half forever. But if you knew the rules, it really isn't 70 and a half. It was the year after the year in which you turned 70 and a half. But if you did it then, you had to take two distributions, the first one beginning April 1st of the following year. Who in the world could remember all of that? Only somebody who taught Purdue students and wanted to
Right.
haze them is what Grant would probably tell you if he was online right now, with me talking. So they eliminated that rule. It's now 72. So you don't have to take your first beginning distribution, your what we call required. Hence, you have to take it. It's still a 50% penalty, mind you, if you don't take it. But you don't have to start taking it until you're 72, unless you've already taken it. If you died, Angie, and left me your IRA, and I don't want
Yes.
you to die, but I would recommend you leave me your IRA. That'd be
Okay.
nice.
I'll think about that.
If you left me your IRA, I used to have what was called an inherited IRA because we're not spouses, and I had to begin taking required minimum distributions immediately. Right? That no longer occurs. So if you're already taking required minimum distributions, and here's where this year got so convoluted. The Secure Act passed December 20th of last year. The CARES Act eliminated all required minimum distributions for 2020 because of the COVID virus, right? So everything that we tell you is true with the exception of 2020, right? So if you were taking required minimum distributions prior to 2020, you have to continue to do so, but not in 2020. If you didn't take them in 2020, you don't have to take them until you're 72, but you still don't have to take any in 2020. You can still do a QCD, a qualified charitable distribution, which I'm a huge fan of, very, very, very supportive. But those are the deals. So the difference, you ask, Barb can roll it into her IRA. If I left it to you, you cannot roll it into your IRA, and you have to distribute all of the money, none this year, none the next year, none the year after, but all of it over a 10-year period of time. And it can be that last year.
Okay. How can converting some of your IRA over to a Roth help your beneficiary?
So one of the rules that we have with a Roth IRA is that it's not always in your best interest, but it's always in your beneficiary's best interest, right? Even if they're in a lower tax bracket than you are, right? I mean, even if they are, right? My kids are in a lower tax bracket than me. A Roth IRA is still better for them than it is for me. Why, you ask? Very simple. The taxes have already been paid, right? It's just the way that it is. So, using a Roth IRA, and you can use these words that are called inclusive and exclusive. They were very, very confusing on the CFP test, so I'm not going to use those today. What I'm going to say is if I do a Roth conversion, taxes are owed, correct? I'm converting money from an IRA or a 401k into a Roth. Taxes have to be paid today, right? That's coming out of my estate. On the other hand, if I left you an IRA and you pulled the money out of the IRA, Angie, who pays the taxes? You do, right? So that's where you get into this exclusive, inclusive, all of this other jargon that we use. That I think tries to complicate people's worlds and pay attorneys. But that's beside the point. So Roth IRAs are better for your children than they are for you, but they could be incredible for you, especially younger people who have a lot of money in tax-deferred accounts so that it doesn't wind up on your tax return when you turn 72.
Well, we had a couple live questions come in, and I think you kind of touched on this, but how can I prevent my children from being forced to distribute my IRA once my spouse and I are gone?
I think here's one of the big ones. Understand your charitable gifting strategy. I think most people, when I sit down to help with most planning, even of generous families, I find their charitable gifting strategies flawed. I find their heart's in the right place, whether it's to their church, whether it's to a museum, whether it's to Purdue, IU, Ball State, AU, whomever. I find your heart's in the right place. I don't find somebody who has sit down with you and said, hey, here's the best charitable strategy that you can use in order to get the most amount of money to the donor or to the charity you want to support and the most benefit either to your tax return or your heirs' tax return.
Well, someone else asks, why should we be worried about our children having to?
So what happens, and this is going to shock you. It shocks everybody I hire, right? I mean, Angie wouldn't have believed me when she started 8 years ago. I'm not sure anybody would have believed me, but I've done this for 32 years. And what happens is you get account statements all of the time in front of you, and you want to take those statements and watch that money grow. The last thing that feels natural is taking money out of those accounts, right? And actually using the money, right? So what's going to happen when I die and my kids inherit my 401k and my IRA, assuming that Barb's not here to be the recipient? What's going to happen is they're going to have one heck of a party in day one, or they're going to have changed their ways, right? And they're not going to want to pull money out of the accounts any more than I did. And they're going to delay it as long as possible. Now, what happens, let's pretend like it's $100,000 that's in my 401k now, and I die, and they have 10 years before they pull it out. So it's not just the $100,000, it's $100,000 plus 10 years worth of growth, and they have to take it all out at one time. And when you think about that, it puts them in the highest tax bracket. So where we have to engage in this ongoing tax planning strategy of how much should they recognize every year, or one of the strategies, and I'm not going to lay it out on this radio show, but one of those strategies very much is, should I skip Barb and leave money directly to Kaylee and Kendra so that they can take money out before they inherit Barb's, assuming that I die on time, which means first,
Right.
according to the IRS and life expectancy.
Someone's also asking real quickly, should I do my conversion? This is a Roth conversion question, all at once, like my banker's suggesting?
Okay, so here's the deal. We are going to run out of time, but this is why we're streaming, right? On WIBC, on Shine, on Wilo. I've got to end this at certain periods of time. You can always go to our website at yourlifeafterwork.com. You can listen to our podcast, consider this program wherever you listen to podcasts. I'm going to continue to answer this question, even though on the radio I'm going to run out of time. What I will tell you is call Angie at 800-928-4001. Get signed up for a Next Steps meeting. We will tell you in 90 minutes, and I don't waste time doing anything, but we'll tell you in 90 minutes, here's what we think you should consider today. Here's what you're going to want to consider in the future. And if we choose to partner together, here's what FEG will do for you. Why should we be worried about our children distributing an IRA in 10 years? Very, very simple. They're going to pay higher taxes.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Welcome back to Consider This program. I am your host, Joe Clark.
And I'm Angie Kinzer.
So I've got to set this up for you. There are, I am the Rodney Dangerfield of the financial industry.
Really?
Well, if you've never seen Back to School, pause the show, go get the video and watch it.
Okay.
But what you have is Rodney Dangerfield, who was hilarious, right?
Yes.
Rodney Dangerfield is a fat guy that didn't go to college, that decides he wants to go to school when his son goes back. He owns a Fat and Tall store. They called it Big and Tall. I've always called it Fat and Tall, and I'm allowed to do that because I shopped there my entire life, right? So he owned a Fat and Tall chain of stores, and Rodney Dangerfield goes back to college. He bought a building, right, so that they would admit him in because he didn't qualify,
Yeah.
right? And so that he can be with his son. And so you've got this dorm floor, not room, with hot tubs, and I mean, you can imagine all of the other things that came along with that,
Yes.
right? Did the triple Lindy, if you ever hear anybody refer to that in a swimming pool, that came from Back to School with Rodney Dangerfield, right? This is by far one of my favorite shows in the world. And in part of it, Rodney Dangerfield is sitting down in front of a professor, and he's in the back of the room, and this way too uptight professor is talking about what you have to do to produce a widget.
Okay.
And finally, Rodney has had enough. And he raises his hand and says, wait a minute, you forgot about the kickbacks. You forgot about all of the other things that really have to go on to make a business run, right? So you've got the academic approach and you've got the what it really takes to make this happen. So when I started in the industry, it was 2 weeks before the crash in 1987. I started in the industry. My family had no money. They're all public educators, right? We had no money. I had no concept what a mutual fund was. I grew up with volatility. You lose 23% in a day. That sounds pretty volatile to me, right? And I show up at the office and the poor office girl's crying and everybody else has quit, right? So I had to Rodney Dangerfield it.
What
right?
year was this?
1987. So I had to teach myself what this industry was about. The guy that owns the studio that we're in is just, I'm sure, dying because they watched me go through all this. I was in his wedding a lot longer than 20 years ago. And I mean, it was learning this on your own is not easy. Then I went back to the academic world, wound up being a professor at Purdue. So I can challenge things a little bit different than you saying, well, this is the way that it's always been. I don't care how it's always been.
Right.
What I care is what makes the most sense for the families that we take care of, right? So anyhow, back to you.
Well, I mean, and we've talked a lot about phases of finance. So when you're in, I mean, and most of the families that we take care of are in the distribution phase.
All right. So, all right. I apologize. I got on a tangent. I do love Rodney Dangerfield. I think he's hilarious. What I noticed over 32 years of doing this is people tend to look at their statements all the same way. Whether you're my age, Andy's age, my kid's age, statement comes, people's eyes go to the bottom. How much is it worth? I think you just made two very major mistakes there. One is you need to understand the tax diversification, which we will teach you and preach to you inside of the Financial Enhancement Group if you call Angie and get set up for a meeting. The second one is that we look at that amount of money differently. We should look at it differently based on where we are in our life. So accumulation is when you're young and you're still putting money in, and your attitude, your strategy should be different than when you're my age at 53, where I'm saving money today, but it can't match what I've saved over the last 30 years, right? 1 year will not make up for 30 years of savings and compound growth, right? And eventually, whether it's by your own choosing or the IRS's, you're going to distribute. It's why we own defineddistribution.com, where I teach people, you either have your plan or the IRS's plan. Pick one. Yours is probably better. All right, back to you.
Back to me. So what I was going to say is kind of take us through the phases, like what are they supposed to look like?
All right, so in accumulation, I mean, you want to go this basic, right?
Yeah, let's go basic.
So in accumulation, your objectives, and I always come up with the top two objectives for each thing that I do, just because I think it's easier to remember. Andy Stanley, my favorite pastor, says he only will preach about one thing. That way, 20 years later, you remember the one thing. We're taught in speech class at all universities to always have three things because your mind tends to think in threes. I have no idea 25 years ago why I decided I should use two. But here you go. So we have two in each of those categories. In accumulation, you care about two things. Now, there's a lot of things to care about. But the two things that you really, really want to focus on are the percentage of income that you are saving and accumulating. So it doesn't matter if you make $100,000 or $10,000. Save the right percentage. The younger you are, the lower the percentage you need to save. You just need to stick with it forever. The second is building tax diversification. That means having some money that is Roth IRA'd. That means some money that's after tax and some money that is tax deferred. You do not know what the IRS is going to do to you in the future. All I know is they need to extract tax dollars from you. You want to have choices from which to pull money. That means you need that tax diversification built up and developed.
I've noticed on our statements at the Financial Enhancement Group, they're all colorful and they look like a
pie chart.
Yes. And
you thought, because that's how everybody else does it, that was talking about large cap growth and mid cap growth and small cap, didn't you?
Yes, but I know
She's
better.
only been here 8 years.
I know better.
Now, we do, on that very first page where you can see your amount, we break it down to the tax diversification. Because there's the asset class that you're in does not matter near as much as the tax diversification that you have built. Nothing. No, not even anywhere near in comparison.
And, you know, talking about statements, when you say that people open those up and they look down here, do you think it's because people don't know what else to do with those?
I think part of it is
I mean,
that. I think part of it is we now have a amount of wealth that few families have ever. I mean, today, you know, we have people who come in with $500,000. We have people who come in with $1.8 million. That is a very, very common number. You know, when I sit down and look at statements, and I think it's because of when you could start putting money into 401ks back in 1980, and where the market growth is. So people will hear me on this radio show, and I guarantee you're going to have a call. And they're going to go, how did he know I had $1.8 million? It's because I got 1,100 of you, you know, we talk to and converse with. So I understand how all of that is being processed and take place. We're not that different than we think we are. So that's accumulation. Preservation is where I am today. It's where I add does not have any ability to make up for what I'm adding this year doesn't make up for what I've already had. It's the only time, by the way, that average returns matter. So if somebody talks to you about an average return in accumulation or an average return in the next phase, which is where I've spent my career in distribution, just walk away. If they're trying to talk about average returns, distribution is based on two things. It's based on volatility of the average price point between when you take money out. So think about the volatility of 2020 and the COVID virus, the tech wreck of the late 90s. But the second thing it's based on is how much is my average dollar taxed, which takes you back to the beginning. Ladies and gentlemen, there's a theme. If you don't build tax diversification, you have no capacity to control those taxable withdrawals.
okay, we got a question in. Are the phases of finance based on age?
No, they're based on need and based on the amount of money you have. So every now and then we find somebody who, for one reason or another, was not able to begin saving and accumulating until they were 50. I have a lot of people that are in their 90s right now that we take care of that never really had access to a 401k. They certainly had no access to Roths. I mean, they were over 70 by the time a Roth existed back in 1997.
Wow.
You know, and that's the hazard of doing this. So you can't say that they're based on age. What I can tell you is somebody who turned 18 today, this is what I would tell them. And the biggest part of age is the younger you are, the lower percentage you have to save. You put together, I take no credit for it, you put together a challenge for kids. I believe you still have access to that if you're listening to the show.
Yes.
That you can go back and get. Adam Harder, one of my partners, CFA, did a great video, great clip on understanding the effects of compound interest. But y'all know Einstein, guy with the crazy hair, right? Did a lot of neat things like the theory of relativity. He said on his deathbed, allegedly, I was not there, but allegedly he said, I don't know what the 7 wonders of the world are, but I know the 8th is compound interest. I think Adam does a really good job walking your kids through that. And again, I would call Angie at 800-928-4001. Tell her I want my kids to watch that. There's a program for 8 to 12.
There's a program from 8 to 12 and then 13 to 18.
Not for children that are that age.
Yes, because we
you can watch it anytime.
Run 2 different classes so that it's age appropriate. And it's 4 nights of a 30-minute class, and we had great participation in it. So it was really, really fun.
It's fun to watch that and understand my family are all public educators. So for me, this is an addiction. I get paid to teach about something that, and I get asked why I do this. I mean, I guess in theory, I could have done any business that I wanted to do. But when I look back at my mom and my dad and my aunts and uncles and my cousins who all taught, the biggest struggle that I saw them have was understanding money. And, you know, at the end of the day, we all want to matter, right? I mean, I may fess up to that more than some of you, but at the end of the day, I want Angie to say I made a difference in her life. And I try to live my life that way. And what I have found is most people struggle financially in terms of what's going on. So, you know, accumulation, preservation, distribution, and they all bookend. In distribution, the amount of money that you have that is tax diversified is critical because you have those 2 goals, right? You have the volatility And the second is the tax amount charged each of those dollars. If you do not build tax distribution in the beginning, then you have no chance to control tax diversification at the end.
So we have some live questions, which we may not hit on the radio.
So call Angie, 800-928-4001. Get signed up for a Next Steps meeting. That would be one. Two, stick around. We'll answer this during a live stream. The Next Steps meeting, it's a freebie. We do it. 800-928-4001. Give Angie a call.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you, on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
Angie's fired up about something.
I'm fired up, or one of the listeners is. So how can average return not matter in distribution?
Because you have an outflow of money. And that is honestly, whoever asked this question, feel free to, call Angie, get my cell phone number. I'm happy to walk you through this conversation. Some of the smartest people I know are Six Sigma engineers. And if somebody tells you they're Six Sigma and they look like me, it means probably not Karate Kid Six Sigma. Or black belt, I guess I should say. They know a process called Six Sigma. They know more about math than I am ever going to learn. But some things are flat out elusive. And when you have an average return, even though you know there's volatility or what they would call variability in markets, in other words, going up and down, in a preservation standpoint, the only thing that matters is your average return. But Angie, there's a rule that I left off.
Okay.
The average return only matters if you can be there beginning, middle, and end.
Yes.
So you had to be able to stomach the tech wreck of 2000, the ugliness of 2002, the Great Recession in 08, 09. You had to be able to deal with COVID and all of the other hoopla that we've had going on this year that have had the markets fall the fastest in history and also respond positively the fastest.
If only you had your whiteboard where you could show up, down, up, down.
Yes.
And if you take it out here, it can't grow back up.
And Angie's seen me display this a bunch of times. So in an average return, if you're there beginning, middle, and end, the volatility doesn't matter. If you take money out in March of this year at the market's low, it never got a chance to grow back up. It doesn't matter that the market regained 35% for those dollars that were spent. That's why, my friends. That's why if you're talking about distribution, you really need somebody who has spent their life on this. Understand the difference between income and assets. And when you get those statements and you look at the total value, you are looking at assets. It is my job. It is my drive in life to help you understand in distribution, it is about the income that comes from it. Whether it's Grant, Aaron, Jamie, Dean, Paul, Richard, Sarah, those are our planning team. Whether you're sitting down with Sarah, our job is to help you understand the difference between income and assets. And believe me, people do get confused over that stuff. You are not alone. More than happy to talk to you. Give Angie a call, 800-928-4001 in 90 minutes.
Yep.
We will tell you things you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you. Have a great week.